The day we'll be talking about Tesla again today at 1 o'clock. Elon Musk starting his own political party. That'll work. Tesla down 6.7%, breaking under that 200-day moving average. So this is kind of where we start to turn our attention to how low can it go. And momentum has been choppy on this. This is an intraday trade. There's probably going to be a reversion at some point, and the trade will obviously be emerging as you move into later this day. But as I've noted, again, join us today, 1 o'clock. The key thing is this. You only need one stock. Tesla is turning into that name right now. Good morning, Eric in Northport. Good morning, Bleak. Good morning, Wamucha. Good morning, Doji. Eric, Bleak, again, Fall, Doji, again, Stardust. Don't know any of your names. We're just going to go with the emojis and everything that comes with it. Just looking at the state of the market right now on the future side. Will is up a little bit this morning. We'll mention this briefly. OPEC providing a little bit of support. Seeing gold slip a little bit more. We're going to talk about the big, beautiful bill. And this is one of those days where, guys, this is going to get a little heavy. I'm going to warn you. But I want you to understand how the market works. And I want you to, like, if and when we get to a situation where the S&P 500 doesn't hit 7,000, but it hits 9 in, like, the next 5 years, I want you to understand why. Because it's all in this bill. And it's just nobody sees it. But I'm going to walk you through what the dynamics of a melt-up are and what happened back in 2017, 2018 that has created this feedback loop that has led our markets higher. Now, as I'm stating this, I'm just going to tell you what goes up will come down. But there is something within this bill that is extraordinarily bullish, and it has nothing to do with a single line of the bill itself, except for the numbers behind it. All right, so as we do every day, remember, before 9:30, you better be with us. If you're not, you are someone else's meal ticket, because 9:30 will be somebody else's exit. We'll see a little bit more selling likely on Tesla. We'll see if some executives and some insiders start buying any names. But you're going to get the list. You're going to talk about the stocks that are breaking out, breaking down. We'll talk about our watch list, but once again, today, 1 o'clock, we'll be talking about why you only need one name. On the macro side, tariffs are on watch. We have a deadline. Once again, I know that this is a little small, so let me make it bigger, because I know that people do want to be able to read things. I don't know what's going on with the PowerPoint presentation, but here we go. The macro side here with the July 9th pause on the reciprocal tariffs expiring, talk of a August 1st effective date for a 10% BRICS tariff. Futures are signaling increased volatility. S&P futures were down when this analysis was done. But I just want to keep you in the loop here. Like, we're going to be watching this once again. There we go. Eric understands what's going on. Means he read the other morning piece. So let's take a look at this real quick. All you need to do is be paying very close attention to the FNGD, because as I will note, when it comes to the financial markets, and you're going to see this in a minute, it is really about leverage. It is really about the ability to take short duration bills, lever them up, create this basis trade, but also leverage up in equities. And in the event that we have a major deleveraging event, it is going to show up in this chart. It's going to show up with the FNGD, the microsectors FANG plus index inverse ETFN times 3, breaking above its 50 and its 20-day. And that is because the way that this is structured, every time that there are moves, this fund actually has to take net short positions at a time that things are deleveraging. So this is a leveraged ETN on the other side. Well, the point is, nothing good happens for the market when this breaks above that moving average. So I want you to keep a very close eye on this 20-day moving average EMA on the FNGD, because if there is another problem with trade, as there was back here in February, we saw the drawdown on the on the markets with the S&P 500. We'll look at the SPXL right now, the leveraged ETN or ETF. We saw the breakdown start back here on February 21st. It was the March period where the trade problems really exacerbated, and we started to see bond prices fall at the same time that stock prices fell. That doesn't happen very often. That's a problem. So in that event, we want to pay very close attention to these 20-day moving averages, because nothing great happens under those levels. So we don't have any significant warning yet, but just pay attention to the flows. Futures And dollar strength, S&P 500, NASDAQ, Dow down a little bit earlier this morning, reflecting hedge positioning ahead of this tariff announcement. And oil is kind of chopping around right now. OPEC supply increases 411,000 barrels per day in August. Tariff headwinds are also cooling prices. So just keep an eye on the OILU, which is the leveraged ETN around energy. If this starts to break down under these moving averages, oil will naturally be a short. And at that point, we're going to turn our focus to a company like Apache, which has a higher beta, 1.2. If this starts to break under these moving averages, that is where I'm going to start moving against the energy sector. One stock freedom plan today, 1 o'clock. They're giving me 75 minutes. I had 90 last time, so I better get everything done, get everything down. Talking about broader momentum in this market, key thing, once again, we're in breakout territory. Stocks that are weakening, Tesla under pressure, EQT under pressure, and Alibaba showing up as well. I haven't paid a lot of attention to China in recent days, but you could see this started to break down back here in mid-May. 132 taking you down to 107, and now pushing under that 200-day moving average. If you want to short Baba, cleanest way to do it. 108 is your line in the sand for Alibaba. Looking at the breakout stocks, Coin, Hood, BCC, RS, look, you knew this is going to happen, and you know that you got a lot of emphasis and focus on crypto in this, bill that we have coming up, and a lot of focus on like what the Trump sons are doing and the companies that they're joining and what boards are they on. Well, the moves largely already happened on some of these names. But once again, when you get into this environment where you have a lot of capital sloshing around, I just want you to keep Hood in mind. It's not necessarily something to trade at this moment, but every time that we get a positive momentum reading, Hood has done very well. The stock has gone from 42 to 92 since our last swing on momentum back on April 23rd. Today's watch list is AAT, FPH. Old school names, have not seen America Assets Trust in a while. Chopping about. A lot of focus here because it is a REIT on interest rates. So once again, baked in stop here at $20. We have FPH, which is 5 Point Holdings. This has been a good little stock for us on breakouts at some points in the real estate market. This was on our early list of F&G stocks at the start of the year, and we had this move higher. So if you're trading it, just a very short, small stop, probably back here at around the 50-day moving average, which is about 550. And on the other names, Green Brick, we've seen some moves once again in the energy or in the housing space, residential construction. These were the stocks that were absolutely hated. But once again, when we did that analysis of the 13 Ds and the insider buying, there was a lot of these construction names on this list because of their valuations. MHO is the last one. MI Homes, keep a very close eye on this one as well. This can break above its 200-day. There is significant upside to this stock. Garrett, what does not much mean on your slide? Well, what I mean by that is there's not a lot of weak stocks. Sorry. Once again, we are in an environment where we have absolutely screamed off of bottoms, and we've shown that in recent weeks we've seen a lot of buying in a large number of different sectors. Regional banks have seen an ample amount of purchasing, some of the strongest purchasing since 2016 in the banking space. I don't know what is necessarily driving that at this point. I'm not a banking person, but the KRE continues to scream higher. I know that this is one of those stocks that, or one of these funds that, looks a little frothy at the moment. I'm going to get out of the way of this, and I'm going to try to understand what's going on. And my expectation is that a lot of this has to do with reform expectation through the Treasury Department. What they're effectively trying to do is not hold a lot of the community banks and the regional banks to the same level of regulatory oversight as the mega banks. So we'll probably be hearing a little bit more about this summer. Once again, there's dozens and dozens of community banks that are trading for less than their tangible book value, which means they're trading for less than what they are actually worth. And we're seeing that because of capital allocation and regulation issues. We talked about this. There's about 32 companies in the Russell 2000 that are upstream oil and gas companies that are trading for less than their book value. It just speaks to the capital allocation, the misallocation of capital in the financial system. And as I show this every day, I think it's just fun to watch. Just look at the number of stocks that there are today. There's 5,526. And how many ETFs are there today? 4,303. So we are on pace by the end of the year to potentially have more ETFs than stocks. Hey. All right. So I want to show you something today that is a little complex. There's a lot to it, no doubt about it. But this is how the system works. This is this is something, because as I dig into this and I want to be able to walk you through it a little bit, the purpose of the conversation today is obviously I've said before that all you really need is one particular ticker that is linked to all of this to make it to be successful. And what you're going to see is that in this environment in which we operate, the financial system is completely and totally dislocated from any fundamentals. And I know that you know this, and I know that I've mentioned this multiple times, but at the end of the day, it's really important to just take a little bit of a step back and understand where we are and where we've come from and why the treasury market is really driving this system. So we're going to really be like pulling back the curtain on the mechanics of this treasury market and how they actually drive equities. And this is not something you're going to see on CNBC. This is not something that you're going to read about in Bloomberg. I assure you, not a lot of people even want to talk about this. They don't even want to admit it. But this is how the system works. Hashpipe knows exactly where I'm going with this, right? You know exactly where I'm going with this. This is not about bonds. This is about the financial plumbing that supports global liquidity. Now, I use that term global liquidity. It's just money sloshing around. But changes in treasury issuance, and what I mean by that is that the Federal Reserve is not engaged in this process. The Treasury Department is. When the United States needs to fund its operations, it can choose through auctions of what is it going to sell. Is it going to sell 10-year bonds? Is it going to sell 30-year bonds? Is it going to sell short duration T-bills? Well, as we know in this environment, what's a little concerning is the fact that at this very moment, not a lot of people want to lend the United States government a lot of money at 30 years, particularly at current interest rates. What would they want it for? It might be 7%, 8%. It's got to stay above inflation. So what have we been doing as a country? What have we been doing to fund ourselves? Well, this is where the magic happens, right? Because changes in the issuance, again, choosing between short-term T-bills and long-term bonds and how we issue it and what the demand is, this ripples through every single repo trade, through every single equity hedge, through every single liquidity operation. And it all starts back in 2017. But the Treasury market is the largest, most liquid government bond market globally. It serves as the foundation for collateral pricing and leverage in global finance. And changes in that issuance and structure have wide-reaching implications. Here we go. In 2017, as you know, you're focusing on the big, beautiful bill today. But I want to take a step back. Let's go back to 2017. 2017, we passed the Tax Cuts and Jobs and Tax Cuts Act. Tax Cuts and Jobs Acts. TCJA. And this was signed in December 2017. This cut the corporate tax rate from 35% to 21%. That's the IRS citation. I add citations where necessary. And at the time, this Congressional Budget Office projected a $1.5 to $1.9 trillion deficit impact on this. To fund it, the Treasury had to make a choice. They can go long or they can go cheap. They can go long with 30-year bonds, or they can go cheap, which is the reliance on short-term debt. This is important because this is where the entire system has changed. I thought it was 2020, and I spent basically the last 4 or 5 days digging deeper into this, and this is my conclusion. In 2016, T-bills made up about 11 to 12% of our marketable debt. 11 to 12%. And by the end of 2023, it was 21%. Now, why does all of that matter? Well, it matters because, as I'm going to show you, short-term duration is lightning in the bottle for borrowing and leverage in the financial system. Bank of America now projects that short-term issuance could push to 25%, and especially on the back of this bill. And while that might sound technical, it has massive implications because this is high-octane fuel for the modern leverage machine that is our financial system. T-bills are important because they are pristine collateral. They're short-dated, they're low risk, they're accepted everywhere. They are like a Swiss Army knife of the global funding system used for repo, regulatory capital, and flight to safety trades. And what's interesting about these is that you, and I'm going to show you in a moment, you can lever these things up very, very quickly. And it's staggering. If you want to, I could show you how I could take $100 million and leverage that up into about $2.5 billion in 2 weeks. Now, remember, I'm just levering up. I have to unwind that if there is a serious problem in the markets. And we have had 2, 3 massive ones in the last 6 years. So again, these T-bills will support regulatory needs. They will provide institutional cash and help them manage it. But here's the core thing. Within the repo markets, in a repo trade, a fund hands over treasuries and they get cash in for that deal, right? Pretty simple. They agree to buy back those assets later. It is a short-term collateralized loan, and the cleaner the collateral, the better the terms. And right now, this entire market is absolutely drunk on T-bills because low haircut, high demand, and in some cases, no haircut. No haircut. You don't have to provide anything. You can just lever up at zero haircut. We'll talk about that in a minute, what that means. So banks and hedge funds and money market funds and dealers are very happy to take these T-bills. Why? Well, right now, you got 27 last year, doing some basic math from the Treasury report back in 2024. This is not abstract, right? These are hedge funds that are using T-bills for basis trades, money market funds that are hoarding them for yield. Banks are needing them for regulatory buffers. Everyone wants in, right? But here's the math. If marketable debt was around 27 trillion, and if 21% of it was a T-bills, that's about $5.9 trillion. If you add and move this up to 25%, this could add about $1.1 to $1.2 trillion in fresh supply of T-bills in the next few years. And if you apply that to repo leverage at 4x, 5x, even 10x in certain structures, you're now talking about $6 to $11 trillion in possible liquidity. And all of that money has to go somewhere. And in some cases, most cases, it ends up in the equity markets. This is what has been happening behind the closed doors, behind the scenes for 8 years. We are in a new financial system that a lot of people have no idea how the hell this works. So when Janet Yellen said, well, we had a lot of leveraged hedge funds that were selling U.S. bonds, nobody asked, well, wait a minute, why do they have them in the first place? Because there is a reliance on these funds to fund the U.S. government. And the way that it is structured, the amount of leverage that is put into it allows them to use the repo market over and over and over again. And on a position of $100 million, turn that into $560 million on debt. If you look into your account, look at a TD Ameritrade account. Now look at like Thinkorswim. Look at anything and look at what your treasury capacity is to buy. That's the leverage. You have unlimited amount of money to play with just so long as the repo market doesn't have a spasm. Why does all of this matter? Well, this is where we bring in the collateral side, right? Hedge funds, basis trades, macro strategies. The basis trade was what was imploding back in April. Money market funds, we had a huge money market spasm last year, back in April 2024. And when that happened, the market fell quickly. These events, these money market unwinding events are what are happening. That's what this was. That's what this was in August. That's what this was last April. That is why we're having multiple sigma events. All of the leverage needs to be unwound very quickly. The markets are breaking down, and then the central bank has to step in or someone else has to step in and provide support. That's what's going on. I couldn't figure out why the hell we're having literally Taleb-style events once or twice a year. This seems to be the best explanation. Now, dealers and banks, regulatory liquidity buffers, this goes back to the SVB crisis. All of these participants are recycling this collateral for leverage. That is called rehypothecation. Now, why does all of this matter? This is where it gets really wild. This is called the zero haircut phenomenon. Normally, you borrow $98 against every $100 in Treasury. That's called a 2% haircut, right? And then what happens is, now that you have $100 million, you borrow $98 million, you buy more Treasuries, you then repo that, you buy 90, now you're at $96 million. You could do that a couple of times. You can't go up to 56 times leverage. You can maybe go to 7 or 8. But here's the problem. According to the Fed, 74% of all Treasury hedge fund repo trades have no haircut, which means they are borrowing the full amount with no margin buffer. $815 billion. Do you see it? $815 billion, no haircut. The entire financial system relies on this. It relies on leverage hedge funds to provide the necessary support to prevent our interest rates from going insane. Okay? No collateral buffer means higher leverage potential. And zero haircuts, average leverage fund. I've seen this a couple of times. I've found it tracked to about 6.2x. Negative haircut rebates. This is where it gets really kind of weird, right? Funds use zero haircut financing to run 6.2 leverage on average. With negative haircuts, some hit 9x, and compare that to basically 2.1x for most leverage strategies. So we have systemic sensitivity. I know this is a lot, but if you want to really understand what the hell happened in September of 2019, you had the Tax and Job Cuts Act, you had all this money pouring into short term, and then you had a repo market spike in September 2019. This is how it breaks. There was a combination of tax payments and Treasury settlement that drained liquidity, and repo rates exploded. The SOFR hit 10%. The Fed stepped in with $75 billion in overnight repos, and one hiccup, one little tiny thing, nearly froze the entire repo funding market. This is what we are facing. We are facing an environment where one little tiny thing can cause a significant spasm. And if we go back into 2018 and we saw some of the things that transpired here, this was the same thing. This is QE selling off. And once again, I've said, just look at the pattern. It's the same breakdown, breakout pattern. Breaking under the 20, breaking under the 50. Nobody wants to bid. We have a squeeze. Nobody wants to bid. We have a squeeze. They sell into that. Insiders buy. Massive amounts of policy shift. Market takes off. This is the pattern post 2017, 2018. And we have to be prepared for this over and over and over and over and over and over again, because this is the way it's going to be. This is going to go until it breaks. Now, in 2020, the same thing happened. Treasury market froze. We had $200 billion in basis trades that unwound rapidly. Hedge funds unwound $200 billion in basis trades. And remember, there were no bids. Nobody wanted to touch any of this. The Treasury market became illiquid, despite the fact that it is the safe haven of the entire global financial system. So what did the Fed do? They launched QE4. They provided repo support. They provided backstops to the money markets. Everything, the CPFF, the PDCF, the MFLF, there were limits on safe haven assumptions. And now what happens? We got to keep this party going. We are stuck in this system. This is it. This is what we're doing. Feedback loops will continue to allow this to happen. T-bills fuel repo, repo fuels leverage, leverage fuels asset prices, and higher asset prices increase collateral value, which allows more repo. Now you throw in options, you throw in dealer hedging, and you have a perpetual motion machine that goes until volatility snaps it. And why does this matter? Because pro-cyclical equity demand and low, the Fed wrote about this in 2022. This is all public information that vol will snap it. Now here's where it gets even more tricky. The idea that we will have fiscal dominance. With 21% to 25% of all debt in T-bills, every Fed hike now hits faster. The Bureau of International Settlements has said short duration debt increases rollover and rate sensitivity, and the more we lean on T-bills, the less room the Fed will have to maneuver. This is fiscal dominance. This is fiscal dominance. And this is what the future looks like. And what happens, again, as a result of this is you have a systemic leverage feedback, right? The real danger is not credit risk. It's the forced deleveraging in the system. It's when they have to unwind all of this at once, like we saw with the gilt crisis, like we saw with Silicon Valley Bank, like we saw back with the Nikkei crash, like we saw in April. This is where we're going to continue to see lots of problems in the future. And when margins shift, haircuts rise, or liquidity fades. And the system unwinds very quickly. The Office of Financial Research put it very clearly, simply stating collateral cycles amplify rallies and crashes. And that is your lesson of the day. I hope you see why I don't care about fundamentals anymore. I hope you see that at the end of the day, we have to watch T-bill share. We have to watch the SOFR and the IOER spreads. We have to watch Treasury auctions bid to cover. We have to watch dealer inventory, hedge fund language, gamma positioning. This is not a market driven purely by fundamentals. It is mechanical, it is collateralized, and it is highly reflexive. The plumbing of the financial system is the story, and it has been the story of every downturn that we have seen post-2018. Now, why do I bring all of this up? Because you could trade the SPY, you could trade the Qs, but I'm going to bring it down to one name. I'm going to just bring it down to a company like Tesla, which is extraordinarily liquid, tons of options, tons of focus, tons of noise, tons of news. That's what we're talking about today. All of the stuff that I just laid out is going to be a part of this masterclass. All the things that I have laid out that we're going to start tomorrow impact this name, but this name also impacts so much of the system itself. And as you look at this and you understand, this is not a market like we grew up on when we were studying Ben Graham, or we were studying all of these other types of, fundamental driven, technical driven things. It is not the same anymore. This blew up in 2008, and we did not have a crash every 12 months. We had one in 08, we had one in 11, we had one in 15, and then we had one in 18, 20, 22, 23, 24, and 25. This leverage can take this market much higher. 7,000, 8,000, 10,000 by the end of the decade. No doubt about it, because it is a mechanical melt up. But when this unwinds, it unwinds fast, it unwinds furiously. And if you are not paying attention, if you are a buy and hold person, you are going to be whipsawed constantly. The long-term bias to the market is to the upside. It's going to be very hard for people to watch once or twice a year the market drop 20 to 25% because of the unwinding. if you are buying the ETFs like BIL, no, I mean, like at the end of the day, that stuff is already kind of, I mean, this stuff will go to no bid. BIL is a different animal. I mean, if you look at some of the longer duration bonds, that stuff can go to zero bid pretty quick if we end up in a ugly situation. I mean, at the end of the day, it's not that you're contributing to the problem. I view it the other way. I mean, like, this is where the money's flowing. You kind of have to be involved in this. You have to be engaged in some capacity because that's where all the liquidity is. But, you know, at the end of the day, even if you're such a drop in the bucket to this that I would not, you know, dig your heels into the sand and say, you know, that you're contributing to the problem. At the end of the day, this is how the system's going to continue to evolve. And all of this innovation around short-term duration ETFs and things along those lines, it just speaks to the ongoing financialization of the economy. So I just want to cue you in, right? At the end of the day, it's not about fundamentals. It's not about what stocks are trading at this particular level. Like, I wish that CNBC or Bloomberg or somebody would just have a journalist who covered liquidity and explained it, right? The only reason that I spent the last 2.5 weeks doing this is not really that I'm into finance. It's because I'm a journalist first. Like, I really wanted to understand what the hell is going on here. And when Yellen said, well, you know, there were just a bunch of hedge funds that were unwinding these positions, I thought, well, wait a minute, how significant is this? And wait a minute, more importantly, like, what are they actually owning and why? And then what was the initial catalyst? And from this, it appears that the tax cuts was Jobs and Tax Cuts. I always get that thing backwards. Tax Cuts and Jobs Act 2017 seemed to be the real catalyst to this, right? 11 to 12% of marketable debt in 2016. And now 7 years later, you're at 21%. And the way that the repo markets are structured and the way that the leverage can be amplified, it's not shocking to see this. It's not shocking to see a market that had this kind of slower progression up now taking this type of curve. We've gone up on the SPY from 285 to 623 in 7 years. And you can't tell me that it's because of economic growth. And you can't tell me that it's because of fundamentals. No, it's because they pumped more money into the system and that money was amplified and that money finds its way into asset prices. Domestic liquidity is ample. That will remain ample. And even though we have this ongoing concern about the U.S. debt, so long as this gain keeps going, this can continue to melt much, much higher. This is not about fundamentals. This is not about trends. This is about money. And a name like Tesla, which I've talked about, one of the reasons why I bring it up so much is because it's just so much money, so much capital, so much action, so many options, so much leverage, in addition to the fact, right, that this is a heavily traded name based on news. As I'm going to explain, nothing that is happening in this chart has anything to do with fundamentals. It has everything to do with positioning, the positioning of capital, and the unwinds that can occur and how this stock influences the market and how the market influences the stock and the proper way to trade it. I don't want to trade the SPY and I don't want to trade the Qs. I just don't. I want exposure to one particular company. So again, I invite you to join us today at 1 o'clock. We're going to dig deeper into this name. And we're going to go from there. And we're going to start actively trading it tomorrow. This is a very unique opportunity to really understand everything that I have been discussing this morning, and momentum and insider buying and the company itself when we go live today, right? So once again, toss your books out the window. CFAs, I apologize. MBAs, I apologize. I did the same reading that you did. But at the end of the day, this is about capital positioning. And what I fully expect in the next 18 months, markets to move higher, and then some sort of credit freeze, some sort of issue in the repo market. The Fed steps back in, the insiders buy. We continue to move higher. We have another major event. That's where we are. It's no longer about what the individual companies are doing. matters a little bit, but not on the macro level. And I hope that this was illuminating and eye-opening, and I hope that you can really start to wrap your head around it. I will make these slides available, but I just want you to take a little bit of a step back and understand that there's a completely different world that is not explained through traditional media. And my hope is that every day that you get up and we have these conversations, you can kind of see behind the curtain for the very first time. Have a great day. I will be back at 1 o'clock. And if I don't hear from you, I will be back tomorrow, 8:45 at Market Masters. Have a great day, everybody.